Good afternoon, learners at home and parents. We want to welcome you to today's edition of our online learning. And I believe you are staying safe. I remain your business study teacher, Mr. Shofolue Polisa. And in the last class we discussed on the topic that says source documents. And I believe by now we are already familiar with source documents, what they are, okay? Because we say they are the first or original documents in which we record transactions. And we give examples. We say we have the invoice, we have the receipt, the debit note, the credit note, the cash register, to mention but a few. So this morning we are going to look into another very interesting topic that says double entry bookkeeping. Double entry bookkeeping. And our objective for today, one, we have meaning of double entry. Two, we have how to treat assets, liabilities, and expenses. Double entry bookkeeping system is a fundamental principle of bookkeeping. It is a system in which business transactions are recorded on both the debit and the credit sides of the accounts involved. What do you mean by this? It simply means that every single transaction that occurs affects two books of accounts. One account will be credited, while the other account will be debited. And that's why we have the popular saying that you debit the receiver and you credit the giver. So, like we're saying, double entry bookkeeping principle says for every debit entry, there must be a corresponding credit entry. For every debit entry, there must be a corresponding credit entry. Having said that, it means that in your ledger, which is your book of accounts, okay, you have two sides. On the right hand side, you have your debit, and on your left hand side, you have your credit. So like I said before, the popular saying, the receiver of value is debited. That means you debit the receiver and you credit the giver. Okay, that's what we have here. Receiver of value is debited while the giver is credited. Okay, because the receiver is debited because he's receiving value, okay, which is money, okay, or other form of items, while the giver should be credited because something is going out of the business. So having said that, we have here what the credit side means. We say the credit side on your ledger is denoted by CR, okay, CR of an account is the right hand side of the ledger, like we have said. On the right hand side, you have the credit, okay, this is the sign we use for credit. Then the debit side, okay, we say that the debit side is denoted by DR. Okay, so on the debit side, you always find the R written, okay, on the left hand side of the ledger. Having said that, we want to look into the double entry bookkeeping rules, okay? The two major rules we have here, we say credit the giver, in essence, the giving account, okay, the giving account. You credit the giving account. Then the second rule is that you debit the receiver. That the receiving account should be debited with the value. And having said that, let's look at the subheading that says treatment of assets and liabilities. So assets are the properties that are owned by a business organization. In fact, those assets, they are used to generate income for the organization. And asset examples, we have your land, we have the machine, furniture and fittings, we have the motor vehicle, and so on and so forth. That we call assets in business study or account. Then, talking about our liabilities, they are those things that the business organization owe to other organizations or individuals, especially in terms of money. So we call that liabilities. Now, the liabilities takes away resources from the business organization. Unlike the assets that help to generate more income, the liability takes away the income that have been gained by the organization. So example of liabilities include trade debts, loans, overdrafts. Okay, and for instance, overdraft is when you don't have or you withdraw more than the amount you have in your account, and you are allowed to do that because you operate what we call the current account. So in that case, they can give you more than what you actually have in your account. It's called overdraft. Of course, there will be an interest charged on that. Okay, so you can say that that is the liability to you, because you have to pay back that overdraft. If you get a loan, you have to repay that loan. Okay, and I will say that we'll move into our illustration. Now, to illustrate, we say machine is an asset to a business organization, like we have said before, because it is used in production of goods and services. Based on this, follow me as we go for the treatment of our first example. Alright, for our first illustration, we have this transaction. On January 3rd, bought machine of 200,000 naira. Now, I want to do the treatment, or how do we post it in our ledger, okay? Let's have we post in our ledger following the double entry principle. Now, from this transaction, we say on January 3rd, bought machine 20,000 naira. From here, two things have happened. So the first thing, the two things that are involved is that machine is bought, and for that machine we paid cash. We are not owing. We paid cash of 200,000 naira. So the two accounts that will be affected are the machine account and the cash account. Now we say why do we use machine account? Anytime you are buying an asset that is not to be resold or for reselling, okay, if it's to be used by the company, in that case we put the name of that very asset and open an account for it. You don't use purchase. But when you buy anything to resell, in that case you use purchase account. But since machine, we are going to use it, okay, so we use the machine account as the title of the account. So I will say that from here we say bought machine of 20,000 naira. So it means that we are going to debit machine account while we credit cash account. Why? Because machine account have received value. Okay, we bought machine. Machine account have received the receiving account. That's what I say. You debit the receiver and you credit the giver. That's the double entry principle. So let's go. So what we do here is the date comes January 3rd. January 3rd, we bought machine for cash of how much? 200,000 naira. So we paid cash of 200,000 naira. Okay? Then, on the other hand, cash account is the account that is giving out the value. And as I will say, you debit the receiver and you credit the giver. So cash account has given out cash to enable us to buy the machine. So here, we come here, we say January 3rd, same date, machine. machine and the amount is 200,000 naira. So you can see that the double entry principle has been fulfilled here. Okay, you debit the receiver and you credit the giver. Debit the receiver and credit the giver. So let's also look at another illustration. Illustration 2. It says on January 4th, we received cash loan from bank of 100,000 naira. So also we are going to debit the giver and credit the receiver. Now for this illustration, bank loan is the one that is giving out value. Yeah, it's giving out value because on the 4th we received cash loan from bank. Okay, we received cash loan from bank. So here the bank is giving out loan. Okay, so we say January 4th. January 4th. The bank is giving out loan. Okay, of how much? Is giving out a cash loan. So we put the cash of 100,000 naira. 100,000 naira. Okay. Then cash is receiving value. Okay. So in that case, we have to debit cash account because it has received the loan in cash. Okay. So we title it the cash account, and we say here January 4th. January 4th, bank loan. Bank loan of 100,000 naira. Sorry, let me make this very clear. 100,000 naira. So as you can see, we have also fulfilled the double entry principle. Okay, because bank has given out loan in cash. Okay, so the value goes out on the bank, while value comes in. Cash accounts have received value of 100,000 naira. So having said that, we want to quickly look into ledger. So how do we define ledger? We say ledger is the main book of an account, or in other words, we can say it is a principal book of account. Every account you are doing will end up in the ledger. Okay, so I want to say that we say it contains all business transactions that have been recorded in the journals. When we say journals, we have different kinds of journals. We have the sales day journal, purchase journal, and return invoice journal, and so on and so forth. So just know that ledger is the principal book of an account. Then having known that, let's see the treatment of general expenses. We say expenses are those items that have been paid for by the business organization in order to yield revenue. So when a business is carrying out its operations, it has to incur some expenses for the smooth running of the business. Such expenses could include things like the electricity bill, it could include insurance, it could include the rent for the premises you are occupying if it's not owned by the organization. It could also include the salary and wages you pay to your workers. But in all, your expenses is geared towards bringing in more revenue. Because if you don't have your workers, nobody will work for you to sell those goods and make more money. Okay. So having said that, we'll look at illustrations. Okay, but because of time, we are going to stop here. Now, for evaluation purpose, we say vividly explain the meaning of double entry principle, okay, which we have seen, and we also say define assets and liability respectively. So I'm going to give an assignment that when we meet in the next class will be used as our illustration for the sake of time. So follow me as I give you that assignment. So from the following transaction, we say open all necessary ledgers. These are the transactions. So just open the ledgers. So thank you very much.